Thank you very much. Very pleased to be here with you today to speak about managing supply chain disruption. As you heard, I'm the director of Trade and Agriculture Directorate at the OECD. So I deal very much at a daily basis with issues like supply chain disruption, but the A stands also for issues like what is the fertility rate of Belgian cows. Now, I'm not going to talk to you about the fertility rate of Belgian cows, but you will see a few slides on agricultural trade in this presentation, because we look a bit more disproportionately at agricultural trade than other trade because of this combination of trade and agriculture. You also hear from this trade and agriculture. I'm very much a real economy person, and I'm going to speak from that real economy side about things, but I'm going to try to make a link to finance from time to time. Apologize, please, if I make any mistakes. I want to walk you through this kind of story, and I really want to bring you to the end of what are we doing at the OECD. I will start by telling you a bit about what kind of supply chain shocks we have been seeing in the past years, and you will notice that you have heard about some of them already from Nicholas. Then, and that's different from Nicholas, I'm going to talk a lot about policy shocks, and I think that the trade world is exposed to a lot of policy shocks right now, but maybe they are not coming from trade policies, but from other policies. I'm going to spend quite some time about this. I'm going to say what I think this is resulting in for the international trade context right now at the private sector level. And then I'm going to spend some time on saying how we at the OECD try to help governments to manage supply chain risk, to manage the current situation, whilst not forgetting that our governments officially still stand for open markets and a rules-based international trading system. I'm going to show you why in their action they're not really revealing that kind of preference right now. Let me start with the supply chain shocks. You have seen much of this, but I would like to really draw your attention to that first one here, the global financial crisis. You will see afterwards why. The second one that wasn't mentioned before, but important very much for the supply chains, was the tsunami in Japan. That was the first time when we realized that a shock that hits one company, there was one important supplier in the tsunami region, an important supplier for the car industry, and that company affected the supply chain of multiple brands, in particular Japanese, but not only Japanese brands of cars. So here we started to realize, oh gosh, there can be real risk factors because of concentration in supply chains. First time this came up as a big topic among trade economists. Trump's tariffs, you heard about COVID-19, Brexit. Here, another one that was very relevant for supply chain risk, this ship that suddenly blocked the Suez Canal. Very different from the tsunami in Japan. Here, one company was hit by a geographic risk, and that affected a specific sectoral supply chain. Here, that ship in the Suez Canal affected one particular logistics route, and very much trade between Asia and Europe. Various trade between Asia and the United States was less affected by this because it's not depending so much on the Suez Canal. And then, of course, the war in Ukraine, and here we are, 2023. I would like to draw your attention to the fact that these shocks have been increasing in frequency over the past years. What are we seeing in trade? When we look at the data that we typically work with as trade experts in international institutions, but also in ministries, trade ministries, agriculture ministries that look at trade, and increasingly also foreign affairs or security ministries. We have been very proud at the OECD to be among the creators of the database on trade in value added. That is the database that looks at how much value added are we trading instead of how much final products are we trading. And it gives us a much better sense of how interconnected the world is. So we have been very proud of that database, have been working with that database a lot, but it has huge limitations if in the current context we are being asked by governments, where is the next bottleneck, where is the next problem, how can I have a risk strategy, avoid risk management strategy, and avoid that I'm going to being hit by the next problem in an individual supply chain, because these data look at macro levels. Now, Here, these data show you how much value added has been traded over time. You see an important increase, sharper increase of the mid-90s towards the 2010 period, and then a flattening. This was the happy period. I was partly working at the WTO in that time, where we were saying trade is great, trade is growing, trade is good for GDP, everybody's going to be happier, and the share of trade in our GDP is increasing too. Now, of all these shocks you have seen in the previous slide, one changed everything, and that was the great financial crisis. And these other shocks you are not really seeing here. So the value added of trade and value added increased a lot. Then the financial crisis changed the trend. And since then, we are stable. If you look at if you disaggregate this data to big regions or big traders, you see that that aggregate global chart that I just showed you is very much a China chart. China started to import a lot, exported to others final products. The import contact of trade increased in other regions, but by not that much. And China started to change its behavior after the great financial crisis. That's interesting, because we have been thinking of there's something happening with China after Trump introduced the China tariffs. So we thought that starts to trigger a decoupling story. Now China starts to import less after that period already. But the real concern, the real question we have is what is going on now, are these supply chain shocks? But as I said before, the supply chain shocks, in the aggregate data, we see stability. We hear a lot of talks about shocks. We hear about friendshoring, about nearshoring. We want to trade less. If we look at what is happening at trade in with other data, an advantage of these data is that they go to 2022, is that when we look at how much distance a good travels until it reaches the final consumer, that distance has been increasing over time, still increasing until 2022. All these shocks, all these changes, but apparently goods travel more. We hear about nearshoring, so countries want to shore more with maybe countries that have a bigger political affinity. We don't see it in the data. When we look at the geopolitical distance, that's the light blue line here, it remains constant over time. So if we look at the trade and value added data, that unfortunately only go until 2020, that's a big issue when you want to help policymakers about current situation. So here this data will go to 2020. Or if you look at these other sets of data that go to 2022, nothing seems to be happening. All these shocks at the global level, trade seems to be doing fine. Now, the problem is that yes, I did a PhD as a lead economist on trade in an international institution where we are proud of doing evidence-based policy analysis. I don't believe these data. And then you start calling chief economists in other ministries and say, what are you seeing? What are you telling your policymakers? And then these colleagues tell you, I also don't believe the data. I think we cannot work with these data that we are used to using in order to analyze the current situation. I will come back to this, of what this is leading to in the trade policy and in the trade export environment. But this is a very unique situation where we start to wonder ask ourselves, what tools do we actually have, what data do we actually have, and how much are they helping us in the current context? Why do we not believe that nothing is happening? Because on top of all these supply chain shocks, to which companies are actually adjusting, the economy, the private sector is adjusting quite well, we have a whole bunch of policy changes. And I call these policy changes, as you've seen, shocks and not managing supply chain risks. What kind of policy changes we are having? I'm mentioning 3 of them. I use the term geopolitics turn into law to refer to this tension between the US and China that is leading to a new set of policies Yes, tariffs in the 2018, but different types of policies now. Think of CHIPS Act, think of the Forced Labor Act, think of the investment screening policies, think of the anti-coercion policies, and all these policies with similar names are being introduced at the US level and at the EU level. So the two big other economic markets, other than the China, are introducing these kind of policies. And each of these policies, when you're a trade economist, you can nearly get a nervous breakdown when you see them, because you don't even understand how they are going to affect the behavior of companies. What is going to happen at the border? You just know that something will happen. Many of these policies work through the supply chain and are policies where companies are being asked to behave in a certain way. Now, companies, for instance, in the Forced Labor Act, are being asked to show at the US border that their product does not contain any forced labor from a particular region in China. Now, if these companies work with 2, 3, 4, 5 layers in their supply chains, most of these companies have no idea how they are supposed to show that none of these suppliers has any connection with the Xinjiang region. They don't know what they have to show at the border, and they don't know what kind of information from a country like China is going to be credible. I'll come back to this, but that's new. Companies are supposed to show something, and they often don't even know what they are supposed to show, how they can prove something when things happen at the border. What is also new? Our member countries at the OECD, we have 38 member countries, all industrialized or upper middle income countries. Our members have in common that they are democracies. So most EU countries, the United States, Mexico, Japan, Korea, Australia, and countries like Chile, Costa Rica are members of the OECD. All our members say, we love the WTO. We believe in the multilateral trading system. That's the official statement. But all these policies are explicitly not multilateral because they target one important player in the global economy, China. So this is a big change, a big de facto move away from multilateralism. Climate turns into law. We are seeing new types of policies, very new designs of policies, sometimes with surprising names. I'm thinking of IRA here, that are meant to help the environment. Inflation Reduction Act, due diligence policies in the European Union, CBAM, carbon border adjustment measures, also introduced in the EU, but coming up in other countries. Now, all of these measures, again, measures, you look at them and you, as a trade economist, and you think, oh gosh, this is going to be so trade destructive. This is going to be so problematic. But they have just been introduced. Now, I've been long enough in the business to know that 15 years ago or so, I would be invited to speak to an environment minister in an EU country. And that minister would tell me, Marion, why can I not introduce this environmental policy? The people in the trade ministry tell me it's going to be in contradiction with WTO law, so I shouldn't even touch it. And then I would say, well, in theory, WTO law allows you to introduce environmental policies. They should just not be more distortive than necessary for markets, but you can. But if your experts in the trade ministry tell you that the policy you want to introduce is not the right one, then you may have an issue. In that period, that minister had to fly me in from Geneva to tell her this story because the people in the trade ministry wouldn't even bother to talk to her. Who dares to touch the WTO? Who dares to introduce a policy that may be discriminatory? At the time, the environment minister didn't have a lot to say. That has changed completely. Now, the environment ministry, the foreign affairs, security introduce a policy that may be trade distortive. Trade ministry goes and says, this may be trade distortive. You may end up having a WTO dispute. The minister and the other ministry says, who cares? This is a big change. This is a big change for trade. Now, what is the issue for the WTO, for the multilateral trading system? Not only that people say they don't care, but also that we have a situation here that the WTO wills, the laws at the WTO allow for environmental policies if they are not discriminatory. When it comes to assessing whether a particular policy addresses in the right way an externality without affecting trade more than necessary, actually as economists, we fail a little bit in terms of being able to address that issue. We can do that in theory, but in practice, saying which policy is a perfect one and which one is not, it's very difficult. Now, last but not least, that's very recent. We have now also entered into a situation where government intervention starts to be very fashionable. A lot of spending is happening, and a lot of spending that looks a bit, I'm thinking here of the strategic green reindustrialization type of funding, where we seem to be in something that is a subsidies war, and the term industrial policy, that was a bit of a blasphemy word when I was at the WTO 20 years ago, is totally fashionable right now. So a lot of spending from governments, and if there's one thing on which the WTO has rules is on subsidies. There is a subsidy agreement from the point of view of what do you have to do in order to avoid that subsidies you give are going to distort markets and intervene in the level playing field. So these are big systemic changes in policy. What are they leading to in trade? Well, first, I believe to a lot of uncertainty for international trade. And one challenge we have as trade experts is that we don't know a lot about those levels of uncertainty that you measure to how does that translate into trade costs. We have a bit of evidence here. This is work notably coming from the OECD, that indeed certain sectors like business services, that uncertainty can represent a cost that affects 30% of the changes in trade. So if one country trades less with another, 30% of that can be explained by a higher level of uncertainty in trade between these two countries. So we do know that for certain sectors, uncertainty affects the behavior of firms a lot, affects trade flows a lot, but I am, where I can, asking for more evidence on this topic because it will help me to advise policymakers. There is definitely a risk of some kind of decoupling, because if there's more uncertainty, companies may pull out of certain markets. We do know that companies are being asked to pull out of certain markets. You may have heard of that company in the Netherlands that is not supposed to sell machines anymore for chips production to China upon request from the United States. If this were to happen, what would happen to the global economy? The WTO has brought out projections on this. Is expecting a 5% decrease of real GDP over the long run if the world is going to split into two blocks, with the EU, United States in one block and China in the other block, the rest of the world around. What is an issue for me at the OECD is that my members will be affected in a very different way. So here we have EU, Japan, United States, and you see that the EU and the Japan would suffer quite a bit if they are disconnected from China, whereas the United States, 1% is maybe something you can live with. So if you want to get agreement on the next step in trade-related policies, you have big differences in interests here. Second point, a real issue, is that the level playing field, the discussion is changing completely. Whereas 3-4 years ago, our work on subsidies at the OECD was focusing on how can we measure the amount of subsidies that China is given to the industrial sector and to which extent this is affecting the level playing field, this affecting international competition. Now our own members start to throw similar amounts of subsidies at the industrial sector. So the whole discussion at the potential in the future about the subsidies at the WTO, I don't know where this is currently going to go, given the change in behavior of our members. So in this context, what have we been doing at the OECD? Because on the one hand, our members say, we want open markets. We like the rules-based international trading system. We like the WTO. But on the other hand, they have been doing introducing all these policies that I've been talking to you about. So we are trying to nevertheless support them in thinking about this new way of being global, being open, having a rules-based trading system, but that fits their current needs. In our work, we have been focusing a bit more on this in the past 3 years. That's the time I've been at the OECD, on these 5 areas that I mention here. We have been putting an even higher emphasis on the need for transparency on prices, trade flows, and there's a lot of interest in stocks. I come back to this in order to keep markets as transparent as possible, to keep information as good as possible in order to take at least a certain level of uncertainty and fluctuation out of the discussion. For the same reason, we have been discussing more actively with members how communication on trade, and in particular on prices, is taking place. This is very much related to the issue of fluctuations, risk, uncertainty. I've mentioned to you that as trade experts, we have found ourselves both in Paris but also in many capitals a bit taken aback by all these changes, and have felt that our existing toolbox doesn't help us to advise governments in the way we wish. We have provided a forum of exchange for experts to move on and to be able to give higher quality advice to governments to help them to manage supply chain reductions, supply chain disruptions. We have, of course, started to work on different types of information, on different types of evidence. And because I'm speaking to the finance world, I'm going to have 2 slides on how we are looking at the relationship between trade and finance now. Transparency. In the global financial crisis, I understand that the Swedish House of Finance was created in that period. Now, also something else was created as a G20 initiative, AMIS, the Agricultural Market Information System. That's a global database, publicly available, different international institutions work on this, hosted by the FAO, that provides pretty much real-time information on prices, on trade flows, important on stocks, and on expected harvests for 4 major crops. And the idea was to avoid what happened in the global financial crisis, that if suddenly there's uncertainty, the prices of food go up, of major crops go up, and the immediate reaction of countries is then to introduce export restrictions. That drives prices up even more and creates a bigger problem. That system has worked very well during COVID. When the market started to become jittery, international agencies, governments started to report on the data in AMIS and told the public, actually, in food markets, things are okay, just stay calm. Prices shot up for a few days and went down again. As a result, this database is now being expanded upon request by the G20 into fertilizers, a big theme because of the Russian war, oilseeds, and there have in the past 3 years been discussions about an AMIS for pharmaceuticals, an AMIS for critical raw materials. Second, we have in the food area noticed that policymakers, media are much more, but above all, policymakers are much more easygoing when they report on food price increases than when they speak on inflation in general. Bankers are very careful to speak about inflation because there is this knowledge, we know that by talking about it, we can create this self-fulfilling prophecy and we get more inflation. When the Russian war happened, the discussions about prices, food prices, was just horrifying. Immediately, policymakers would be there and say, prices will go up because Russia can't export anymore, Ukraine can't export anymore, we have a food crisis everywhere. And there was no reason for that, because the most recent harvests were already on the market. And very importantly, yes, Ukraine may have a production problem and an export problem because it's being attacked by Russia, but Russia can produce, can export. It was restricting its exports on purpose. So what we did is we generated really strategically evidence that showed the difference between what happens if Ukraine can't export, what happens if Russia decides not to export. And the communication on these two things is very different and is very relevant for the global policy discourse. So very much look into what is the scenario we are going to produce and how do we generate numbers. I told you that we had these phone calls with my colleagues in capitals, and we ended up in 2022 with a 3 weeks notice, bringing chief economists from 2 or 3 ministries from our members to Paris to discuss, under Chatham House rules, what are the tools you are using to assess supply chain disruptions? What are the tools you're using to look forward? Which data are you using? Can we work together? Can we exchange methodologies? Can we exchange data? Because because we all felt under huge pressure to give very urgent policy advice, and we all felt not well prepared. It's not a nice place to be in when you're towards the end of your career, to feel so useless, but we brought all these experts together, and we really triggered a great network that hopefully will continue to function in order to advise policymakers in this period. Of course, at the OECD, we moved into generating new types of evidence. We look, and this evidence uses more, instead of macro data, granular product or supply chain data, looking into specific supply chains, digging out very micro-level information, and often we have to go to industry literature, and have to leave the trade data world in order to understand where could be the next bottleneck, for instance, in order to have functioning supply chains that are necessary to move into a green transition. What kind of raw materials do you need? Where does the first level of processing take place? The second level of processing? Where are the problems in these particular supply chains? The problems for us is that we have to now work at supply chain level, which means that we have to select which ones. You cannot work on all supply chains at the same time. Last but not least, 2 slides on finance. I mentioned to you that there is a bit of a concern that with all this spending, notably for the green transition, countries start to compete against each other. We manage one particular tool, the export credit arrangement, that is meant to avoid that our members compete against each other with their export credits. So if I have a windmill industry and I want to build those in Africa, typically my home country gives me an export credit that is that has preferential rates than the market currently gives. And now the idea is that I've agreed, if I'm Denmark, with Germany, that we do not go below certain conditions for those particular markets. That's the export credit arrangement. The modernization package that our members agreed on in March and that has been implemented in July is that the members agreed on what do we call a green project, what do we call an environmentally friendly project, and what are the preferential credit conditions that we all give to these projects. So in the middle of all these policy shocks that come from the national level that are really disruptive for international trade, here one first international agreement in a very specific area, export credit, but where different countries agreed on how do we do financial interventions to be green without this disrupting the level playing field too much. So we are very proud of this. Last but not least, last slide, looking at the relationship between trade and finance. In my role, I notably attend a G20 agriculture ministers meeting, and the issue of the role of the dollar in trade, in particular for agri-food trade, has become very prominent. Why? I mentioned to you that as a result of the Russian aggression against Ukraine, agri-food prices, in particular of main commodities, shot up immediately after the attack. They went down to pre-crisis levels relatively quickly. So when I give a talk to my ambassadors, I say prices are back to normal because I use dollar prices from international markets. But if you look at the importing countries, and here are a few of them, prices are not back to normal. Why? Because when there's uncertainty, the dollar goes up. And if you then buy in dollar prices and sell at home, the food has become very expensive for your local population. So when I go to a G20 meeting and present these data, the representatives from African countries get very upset because it doesn't represent their reality. I've told you what we have been doing in the past 2-3 years in order to try to help our governments to think together about policies to walk through this period of change, to walk through this period of disruption, and nevertheless keep markets open and think jointly about rules. If you want to know what we're going to do in the next years, look at the new OECD trade strategy that has been agreed in June at our ministerial conference, and that is called the OECD's contribution to promoting open markets and a rules-based international trading system. It's the first time the organization has a trade strategy, and I think we are proud that we managed to agree with 38 members on a text on something that still is open and rules-based. You will see when you look inside of it that it is nevertheless much more complex than what we have been dealing with in the past, but we hope to be and remain a trusted partner, somebody who maybe hopefully brings some stability into this system in this period of change and help our members to manage these times of disruptions and nevertheless continue to trade with each other. I thank you very much for your attention.